Hello, and thank you for watching this International Financial Reporting for Non-Profit Organisations webcast on non-exchange revenue. This webcast is part of a series that covers some of the key issues in financial reporting that affect non-profit organisations. This session begins by looking at what constitutes non-exchange revenue. Next, we will consider the main issues that NPOs face when accounting for non-exchange revenue. We will then look at how these issues are currently addressed in the existing accounting standards, beginning with the international standards before looking at how some national standard setters have addressed NPO-specific issues. Finally, we will look at the alternative treatments identified in the consultation paper. So what do we mean by non-exchange revenue? Revenue comes in two forms. Firstly, exchange revenue. This is revenue that is earned on a commercial basis. Examples of exchange revenue include the proceeds from the sale of merchandise and tuition fees charged where these are not subsidised. No sector-specific issues have been identified in respect of exchange revenue, and consequently the consultation paper concentrates on non-exchange revenue. Non-exchange revenue arises when an entity receives value from another entity without directly giving approximately equal value in exchange. There are different ways in which a non-profit organisation may receive non-exchange revenue. The non-exchange revenue may be received as cash contributions, for example grants and cash donations. Non-profit organisations may also receive donations of tangible assets, for example a car or medical equipment, or inventory, for example pharmaceutical products or textbooks. These are called gifts in kind. Finally, non-profit organisations may receive donations of services, whether from volunteers or donations of professional services, for example where an accountancy firm prepares the organisation's financial statements for no charge. This table summarises the issues that non-profit organisations face in accounting for non-exchange revenue, and indicates how significant the issue is for each type of non-exchange revenue. In order to recognise revenue, the organisation must be able to benefit from the donation. It must have control. Determining whether the organisation controls the donation can be challenging. This issue is highly significant for gifts and services in kind, and of medium significance for cash contributions. In order to recognise revenue, the organisation must also be able to measure the value of the donation reliably. This is not a significant issue for cash contributions, where the value is obvious, but can be highly significant for gifts and services in kind. Once an organisation has confirmed it controls the donation and can measure its value reliably, the question of when to recognise revenue arises. This can depend on any conditions or restrictions imposed by the donor. This can be highly significant for cash contributions and is also significant for gifts in kind and services in kind. Measurement issues do not just affect recognition. Again, measuring cash contributions is generally straightforward, but the issues can be highly significant for gifts and services in kind. Finally, ensuring sufficient information is provided to meet stakeholders' needs will be a highly significant issue for all non-exchange revenue. An NPO will need to ascertain whether it has control over resources it receives. NPOs need to be certain they have control over the resources provided for them to be recognised. Determining whether the NPO controls cash is generally straightforward, but for other types of resources, such as services in kind, an NPO might need additional systems to ascertain the amount of resource it controls. The costs of determining this may be disproportionate to the benefits that such information will provide. If the donor can change their mind about the donation, then the NPO will generally not control the resources. For example, in many countries, pledges will not bind the donor when they are made, and consequently, pledges are likely not to be recognised until the donation is made. Bequests will raise similar issues, but are not within the scope of this paper. In some cases, NPOs will need to determine which resource they control. For example, a donor may provide a vehicle to be used by the NPO for a specific project and then return to the donor. The NPO will need to determine whether the resource it controls is the vehicle in which case it would have received a gift in kind, or whether it has received a right to use the vehicle without controlling the vehicle, a service in kind. This could affect the accounting for the revenue from the donation. In order to recognize revenue from services in kind, the NPO must control the benefits from those services. When services are provided, the benefits are often consumed immediately. For example, when a volunteer helps distribute food at a food bank, the NPO benefits from those services at the time the volunteer provides their services. It can be difficult to determine whether an NPO has control of services, but if the NPO has received the services and has benefited from them, it will generally have had control of them. Being able to reliably measure a donation is one of the key issues facing non-profit organizations. There are a number of scenarios where measurement can be difficult. Donations of low value but high volume items for resale, for example books or clothes. Many NPOs receive donations of such items and sell them in shops to raise funds to support their work. NPOs may not have the systems required to record the individual items or even to keep track of the number of items of each type that have been donated. Without this information, establishing a value for the donated items will be difficult. NPOs may receive donations of items for onward distribution. For example, a medical charity could receive donations of medical items such as vaccines, face masks, and pharmaceuticals. The market value of these items might be known, but it may be difficult to establish the value to the NPO, especially if some items, such as pharmaceuticals, are donated close to their expiration date. Assigning a value to volunteer time can be a challenge. In some cases, volunteers may be providing their time for professional services. For example, an accountant may volunteer their time to assist with the preparation of financial statements. In other cases, volunteers may assist with distributing food at food banks or kitchens, or may assist with construction and maintenance projects where many of the volunteers will not have any previous training or experience in these roles. These scenarios can also raise cost-benefit issues. For example, would the cost of recording every volunteer's time or recording every donated item be justified by the benefits of doing so? Determining in which financial reporting period revenue should be recognized can be a challenge. Revenue can only be recognized once any substantive performance requirements, conditions, have been satisfied. Revenue may need to be deferred if conditions have not been met. Donors may impose terms on their donations. We refer to these as stipulations. The first type of stipulation is a condition, sometimes referred to as a performance requirement. Until these have been satisfied, the recipient is not entitled to the funds. An NPO might have to recognize a liability which reflects the conditions at the same time as it recognizes the donated item, often cash, as an asset. It would then recognize revenue when or as it satisfies the conditions. The second type of stipulation is a restriction. This is where the donation can only be used for the purposes stated by the donor. In this case, the NPO is entitled to the funds immediately. In this situation, the NPO could recognize revenue when it recognizes the asset, or it may prefer to recognize revenue as the related expenses are incurred. Here, the issue is around communicating that funds are restricted, either through presentation in the financial statements or disclosure in the notes. Options for presenting restricted funds, including the use of fund accounting, are discussed in the separate webcast on the presentation of financial statements. Stipulations on the use of capital assets can raise specific financial reporting challenges. There may be a requirement to use a capital asset for a particular use. This can be time-limited or can be open-ended, and this might affect the recognition of revenue. When a condition is attached to the use of the capital assets, the question is whether the condition relates to the life of the asset, or the period for which the specified use is required, or the construction period. An example would be where a donor provides funds to an NPO to build a school, with the condition that the building is used for teaching for a minimum of 20 years, with the donor being entitled to a refund if the condition is not met. So in this example, the question is whether the condition relates to the whole life of the school, the 20 years it's required to be used as a school, or the number of years it took to build the school. This can be contrasted with when a restriction is attached to an asset. For example, if a piece of land is donated to an NPO provided that it is only ever used as a nature reserve, this is a restriction of use. If the NPO subsequently tried to use the land for housing, the donor may be able to seek compensation. The reporting of any repayment would be a separate reporting event that would depend on the approach taken to revenue recognition. In some cases, cash may be received in arrears after conditions have been satisfied. For example, an NPO may receive funding to provide vaccinations and be paid based on the number of vaccines provided. NPOs will need to determine whether revenue is earned in stages or only when a project is complete, and will need to consider whether they should recognise a debtor for amounts due but not received. Finally, as mentioned earlier, donated items can only be recognised when they can be measured reliably. For items donated for resale, revenue could be recognised at a later time, for example, when the items are sold. But for items donated for onward distribution, there will be no subsequent proceeds as the items are not sold, and so this recognition point isn't available. Where possible, revenue and a matching expense could be recognised as the items are used. As we discussed when looking at recognition, measuring services or assets that have been gifted can be problematic. Assigning value is not generally an issue for cash transfers, but can be challenging where donations take the form of gifts in kind or services in kind. Measuring donated capital assets can be an issue. For example, housing may be donated to an NPO for social purposes. This housing may command a different, frequently higher price for use as commercial development. Should the NPO measure the donation based on its value as social housing or its value as commercial development? Services provided on a commercial basis may be more easily measured. For example, if an accountancy firm provides accounting services for free, the value of the services can be measured at the amount that the NPO would otherwise have paid for those services. However, measuring other services can be more difficult. What value, for example, should be assigned to the time provided by volunteers serving in shops or in food banks? Stakeholders use information to make decisions, and lack of transparency may impact their understanding of an NPO's financial statements. NPOs may face a number of issues when disclosing information about revenue. NPOs may have a mix of revenue, exchange revenue from the sale of goods and services, and non-exchange revenue, as we have been discussing. Disclosing these separately provides an indication of the extent to which the NPO can fund its activities from its commercial activities. In some cases, these may be easy to separate into revenue streams. In other cases, the distinction between exchange and non-exchange revenue may be less clear-cut. An example would be where a school charges for tuition, but this is supplemented by donations. Disclosing this can aid transparency. A standardized presentation of revenue can help provide transparency for stakeholders. Examples of disclosures that could assist stakeholders include identification of revenue that has been recognized immediately but is subject to restrictions, even though it has been included as revenue, and categorization of revenue where there are different accounting treatments for different types of revenue, for example, cash contributions and gifts in kind. Some additional disclosures may help to provide full transparency for stakeholders. Examples include material amounts or activities that are fundamental to the operations of the NPO, the nature, amount, timing and uncertainty of revenue, and items that have not been recognized in the financial statements, which might apply to some gifts in kind or services in kind. However, additional disclosures may have a cost. The costs of preparing additional disclosures may be disproportionate to the benefits. In addition, some entities may not have the resources to provide the information. The desirability of additional disclosures will depend to an extent on the approach taken to the recognition and measurement of revenue. The alternative treatments are discussed later in this presentation. Options for the presentation of financial statements, including the use of fund accounting, are discussed in the webcast on financial statement presentation. The approach taken to presenting financial statements will influence discussions about what disclosures in respect of revenue should be made. This slide summarizes the accounting treatment for non-exchange revenue under the three accounting frameworks. Under IFRS, there is a standard, IAS 20, that addresses the receipt of government grants. The standard requires that revenue from government grants is recognized on a systematic basis over the periods that the entity recognizes as expenses the related costs that the grants are intended to compensate for. For capital assets, this would be over the life of the asset to match the depreciation. IAS 20 permits two approaches: the capital approach, where grants are deducted from the carrying amount of the asset, and the income approach, where grant revenues are initially deferred and then recognized as revenue to match the related expenses. Where the entity has no future related costs related to the government grant, the revenue is recognized in profit or loss of the period in which it becomes receivable. IAS 20 only addresses government grants and not other types of non-exchange transaction. Under IFRS for SMEs, Section 24 addresses government grants. Grants that impose specified future performance requirements are only recognized as revenue as or when the performance requirements are met. Grants that do not impose specified future performance requirements are recognized when an asset is recognized. Section 23 applies to revenue from the sale of goods, rendering of services, construction contracts, interest, royalties, and dividends. As such, IFRS for SMEs has no specific provisions for non-exchange revenue other than government grants. Under IPSAS, IPSAS 23 addresses non-exchange revenue. IPSAS 23 requires that grants with conditions are recognized as revenue as and when conditions are satisfied. Grants without conditions, including grants with restrictions, are recognized as revenue when the asset is recognized. Under IPSAS 23, a condition only exists where the recipient has an obligation to return the funds to the donor if the conditions are not met, i.e. a use or return condition. The IPSASB has recently consulted on two exposure drafts, ED 70, Revenue with Performance Obligations, and ED 71, Revenue without Performance Obligations. These proposals, if accepted, will mean that where there is a performance or present obligation, revenue can only be recognized as these are satisfied. This example illustrates how the accounting treatments under the international frameworks differ. In this example, an NPO receives a government grant to construct a new building. The donor requires the NPO to construct the building. However, the terms of the grant do not specify how the building is to be used once it is completed, nor do they include a use or return requirement. In this example, the expected life of the building is 25 years, starting from the completion of the building. Construction of the building is expected to take 2 years. Let's now look at the accounting entries that would result from following the capital approach in IAS 20. At the start of the first year, the grant of 100 is received. Debit bank 100, credit deferred revenue 100. During that year, construction starts. Let's assume the costs are spread evenly over the 2-year construction period. In year 1, costs of 50 are recognized, debit asset 50, credit bank 50. Under the capital approach, the grant is applied to reduce the carrying amount of the asset, debit deferred revenue 50, credit asset 50. In the second year, the construction is completed, and the remainder of the grant is applied to reduce the carrying amount of the asset, debit asset 50, credit bank 50, debit deferred revenue 50, credit asset 50. In subsequent years, no revenue is recognized, as under the capital approach, grants are dealt with outside the statement of financial performance. No depreciation is recognized, as applying the grant to reduce the carrying amount of the asset has reduced the carrying amount to 0. Let's now look at the accounting entries that would result from following the second approach in IAS 20, the income approach. Again, at the start of the first year, the grant of 100 is received. Debit bank 100, credit deferred revenue 100. Construction takes place over 2 years, debit asset 50, credit bank 50 in each year. Under the income approach, the grant is applied to match the expenses in the statement of financial performance, so the revenue remains deferred during this period. In subsequent years, depreciation is recognised. The expected life of the building is 25 years, so depreciation of 4 per year is recognised. Debit depreciation expenses 4, credit asset 4. The grant is applied to match the expenses. Debit deferred revenue 4, credit revenue 4 for each year. Under IPSAS 23, revenue is only deferred when a grant includes unsatisfied conditions. Conditions always include a use or return requirement, which does not apply in this example. Consequently, when the grant is received, revenue is recognised immediately. Debit bank 100, credit revenue 100. Construction takes place over 2 years. Debit asset 50, credit bank 50 in each year. In subsequent years, depreciation is recognised. The expected life of the building is 25 years, so depreciation of 4 per year is recognised. Debit depreciation expenses 4, credit asset 4 for each year. Under IFRS for SMEs, revenue is recognised as performance requirements are satisfied. As there are no requirements about the use of the building once it is completed in this example, the performance requirements would be satisfied as or when the building is constructed. Depending on the terms imposed, this could be as construction takes place or on completion. Let's assume the requirements are satisfied as construction takes place. At the start of the first year, the grant of 100 is received. Debit bank 100, credit liability 100. Construction takes place over 2 years. Debit asset 50, credit bank 50 in each year. As the construction takes place, the performance requirements are satisfied and revenue is recognised. Debit liability 50, credit revenue 50 in each year. In subsequent years, depreciation is recognised. The expected life of the building is 25 years, so depreciation of 4 per year is recognised. Debit depreciation expenses 4, credit asset 4 for each year. The same treatment would apply under the IPSASB's ED 71 and under IPSAS 23 if there were conditions. The consultation paper looked at the accounting requirements of national standard setters in a number of jurisdictions. Some of these standards are based on international standards, and therefore the national standards replicated the differences in revenue recognition between the international standards. This slide summarises the overall approach taken in the national standards that were considered. One set of national standards are based on IFRS for SMEs, with additional options based on IFRS permitted. This jurisdiction extends the IFRS for SMEs treatment of government grants to other non-exchange revenue. Another jurisdiction has national standards based on IFRS, which provide additional guidance for NPOs when recognising revenue. Another jurisdiction has national standards based on IPSAS. Again, additional guidance for NPOs is included. Not all national standards are based on international standards. One jurisdiction has requirements similar to IPSAS. Donations with donor restrictions are presented separately. And finally, another jurisdiction has an approach that allows an accounting policy choice for donations, a deferral approach similar to IAS 20, or immediate recognition where the donation is presented as a restricted fund. Some national standards include additional provisions in respect of different types of non-exchange revenue. These are discussed on the next slide. National standards include a number of provisions not included in the various international standards in respect of non-exchange revenue. While the provisions in each set of national standards are different, this slide summarises some of the key approaches. Firstly, where items donated for resale may be impractical to measure, revenue can be recognised when the items are sold rather than when they are received. Two ways of addressing donated items for distribution or the NPO's own use have been identified. Where reliable measurement on receipt is impractical, One approach is that revenue and an expense can be recognized when the item is distributed or used. Another approach is that no revenue and no expenditure is recognized for these items. An alternative approach is that donated items of any sort are only recognized as revenue when they can be reliably measured and would have been purchased. This approach is one of two identified for services in kind as well, i.e. that services are only recognized where they would otherwise have been purchased. The other approach is that services in kind are only recognized when they can be reliably measured, and if they can't be reliably measured, that they are disclosed. These provisions have informed the development of the alternative treatments discussed on the next slide. The consultation paper considers 4 alternative treatments for non-exchange revenue. The alternatives adopt a framework for non-exchange revenue based on one of the international standards. As discussed, some national standards have introduced exceptions to the international standards for some gifts in kind and/or services in kind. The table also indicates which alternatives introduce some of these exceptions. Under Alternative 1, the framework for non-exchange revenue would be based on IFRS for SMEs. IFRS for SMEs does not include any exceptions for any gifts in kind or services in kind, and Alternative 1 does not propose introducing exceptions. The treatment of non-exchange revenue that are not government grants would be based on the concepts in IFRS for SMEs. Alternative 2 proposes a framework for non-exchange revenue based on IFRS. Again, IFRS does not include any exceptions for any gifts in kind or services in kind, and Alternative 2 does not propose introducing exceptions. Similar to IFRS for SMEs, the treatment of non-exchange revenue that are not government grants would be based on the conceptual framework for the IFRS standards. Alternative 3 proposes a framework for non-exchange revenue based on IPSAS. IPSAS permits, but does not require, revenue from services in kind to be recognised. However, all gifts in kind would need to be recognised under IPSAS, and Alternative 3 does not propose introducing exceptions for gifts in kind. Alternative 4 is the same as Alternative 3, apart from exceptions in respect of gifts in kind that are also introduced. These exceptions are to permit NPOs to recognise revenue from gifts in kind donated for resale at point of sale rather than on receipt, where measuring their value is impractical. Permit NPOs to not recognise inventory or revenue on receipt of gifts in kind donated for distribution, where measuring their value is impractical. Permit NPOs to recognise revenue and an expense when items are distributed or used to provide services. Require additional disclosures where an NPO uses one of the permitted exceptions. We want your views. The more views we receive, the better informed we will be for the next phase of this project. The consultation paper includes a number of specific matters for comment. The specific matters for comment relating to non-exchange revenue cover the description of non-exchange revenue, whether the list of alternative treatments is exhaustive, your preferred alternative treatment, exceptions relating to gifts in kind and services in kind, and practical considerations such as tax or audit thresholds. Please respond to the consultation paper. The consultation period ends on the 24th of September 2021. Shape the future. Share your voice. Submit your response.